flying colors. Let's welcome on board then Shyam Srinivasan, MD and CEO at Federal Bank, joining in on the show right now. Shyam, always great to have you on the show, and your stock has outperformed all benchmarks, one must say. There's been a very steady improvement in your performance. What's been aiding this kind of move, you think? And how do you think this current credit cycle is different than what we've seen in the past?
Morning. Thank you, Aisha. I can't comment on the stock. I can comment on the performance. It's been, as you've observed, Q1 was a strong quarter, and it's sort of been thankfully trending well, largely because for long periods of time, we've been quite conservative on the credit quality. So that has given us enough space to be not distracted on having collection or portfolio related issues. So it allowed us to sort of widen our offerings and ensure that we have even paced growth across all products and segments. And that is continuing. This time credit expansion at the market level, I'm not talking of this federal, you've observed, almost in the teens, which is a rare thing in the first 4-5 months of a financial year to have a Y-on-Y growth of almost in early teens, indicates 2-3 things. One is the shift from various other streams of borrowing to banks. Second, capacity utilization probably is at almost near high, so enabling or encouraging many people to make investments. And the third, I think there is a pent-up demand post-COVID which has picked up, and we are all seeing that in many parts of although there are talks of the impact of inflation, we are seeing that too resulting in credit expansion. So I think the credit growth as we see at this point in time seems fairly sustainable over a period of time, and we have both risk appetite and capability to grow much higher than that, and that's how we've seen in Q1, and hoping in Q2 and beyond similar or better performance will be possible.
Right. Growth for you has been very strong this quarter. Tell me, Shyam, what are going to be the focus segments going forward? And what is it that you're doing to protect your asset quality in this new credit cycle?
I think I've mentioned, Sean, many instances, we are not excessively biased in any one product category, except in the peak of COVID, when all else had pretty much come down to a grind. Gold was doing well. That has tapered off. And we see now most businesses are growing sequentially 4-5% in the quarter, which annualizes about 16 to 18% kind of growth. And I believe that is very possible. And some businesses which are growing off a very small base, we've just launched our credit cards, our commercial vehicle business. These are growing in, sort of well into the 30-40%, but I must caution, these are growing off a very small base. So these businesses are all incrementally very good growth opportunities, and without taking any undue risk. I've always said that we've prided ourselves on a good credit portfolio, largely because we've been not too courageous on doing business on the fringes or big on unsecured. Keeping those principles intact, ensuring that within our risk appetite, we're able to scale up distribution and offerings. And widening our offering base, such as new product, new segments. We are hopeful that the committed numbers of somewhere in the mid to high teens is possible. And the track for the last few quarters suggests that it is. And I guess this quarter will be no exception.
Right. I wanted to understand your outlook in terms of being able to protect margins and liabilities growth going forward. What is the kind of guidance that you can share on that front?
At the end of Q1, when we were announcing our results, we did point out that margin expansion or the full year margin is somewhere in the 320, 325 kind of zone will be possible. That looks very much on the cards as we speak. The margin is a consequence of many things, right? One is the credit expansion in the right segments, giving us some expansion in the NIMs. Second is the lower slippages, which means your reversal of interest income is lower. And third, the cost of originating deposits. We've been amongst the most retail kind of, our deposit portfolio is largely retail. We didn't and don't usually go in for bulk borrowing. So when there's a customer on the other side, as long as your pricing is quite competitive, we are able to ensure that our cost of funds is somewhere in the top quartile, and I don't see that changing. And in a rising interest environment, obviously the credit gets repriced first and the deposits follow. So there's a lag of a quarter or two, through which period you may get a slight expansion on margin. Exactly the converse of what happens in a falling interest rate environment, where the credit gets repriced and your deposits. So to that extent, the margin expansion in such a situation is possible. And we believe this quarter and the next, we will see some pickup. And that's why I said the full year number somewhere in the 320, 325 is what our margin guidance is. First quarter was around 320, 317, sorry.
Shyam, when we just look at the banking sector, I look at all the commentaries of different banking companies, the names, the sort of expansion that they are doing. You think credit growth is back with a full swing, NPAs are not there in the system, and most of the banks are very well capitalized for growth, if any. Plus, new products are coming in and everybody is spending on digital, NIMs are expanding. You think this is like, the best case scenario for the banking sector?
I won't go into such a generous statement, but yes, it certainly looks way better than it did, say, through the COVID period or prior to that, when some of the banks were faced with credit challenges. I think the point that you make of well-capitalized, clean balance sheets, credit appetite or risk appetite being open for large banks is very much true. Now, whether everybody will get similar or sort of heady growth depends on the risk appetite of each bank and the capital situation. They have confidence to raise growth capital, right? If you have recapitalized your organization and have cleaned up a balance sheet, that's one kind of style. The other is even consistently growing and you are seeking growth capital. That's another kind of environment. But short point, I think growth opportunity, if you believe in the India story, which I think all of us do, absolutely very much there. Wrinkles here and there are likely to be there. But I think if you take a multi-year view, absolutely, yes, I agree with you.
Right. Just in terms of how we would look at the banking sector, the NIMs and how things move ahead, there have been an interesting change in the trend over the last 6 months. We've seen a lot of NBFCs tying up with fintechs. We've seen a lot of banks tie up with fintechs for loan. You think that is the next leg of growth coming in for banking and NBFC sector?
Did you say fintechs tying up with banks or NBFCs
Yeah.
is an opportunity for banks? I think if you see fintechs as a digitally enabled distribution partner, at least that's how we've been working with, as you probably know, we are at the forefront of this, the entire fintech, it's the right word, revolution. We are a bank, go-to bank for many fintech partners, and we seek them out because we build capabilities to work very closely with all of them. We see this as a mega opportunity to increase our reach, and they see us as a good partner to work the banking stack, which through APIs we are able to work with fintech partners. So I do believe fintech banking partnership is here to stay, but there are some caveats there. First is we have to be very clear on the relationship model. How much you share revenues, how do you own the customer, what do you do with the customer, data privacy, and so on and so forth. I think some banks, and I'd like to believe we are one of them, have created that model and the construct which ensures that all the necessary protection is in place. Then I think growth is a big opportunity. But it's not like just wake up one morning, plug and play. So I believe fintech bank partnerships is very strong, but you must have a very strong architecture to make sure that it works. And some of the recent regulatory announcements on digital lending, on fintech, on outsourcing that RBI has come out are very tightly defined. There's not much wiggle room to do stuff outside of that structure. So if you do within that structure, I think there's a large opportunity. And I believe only a few have the model right.
Okay, Shyam, always great to have you and get in all the insights that you always give us each time you join in.